Welcome to the research desk. Imagine you are piloting a high-performance fighter jet through a pitch-black storm in zero visibility conditions. You're flying entirely on instruments.
Right, a terrifying scenario for anyone.
Absolutely. Your altitude tells you that you are perfectly safe. You're maintaining a high cruising altitude. But your horizon indicators suggest you are flying completely upside down.
So severe spatial disorientation.
Exactly. Which instrument do you trust with your life? Do you trust the absolute measurement of your altitude, or do you second-guess it because the horizon just feels wrong? Today, we are applying that exact life-or-death scenario to quantitative finance.
And this marks our series finale, right? The culmination of a really long journey where we've built a comprehensive 6-layer framework strictly from first principles.
It is. Over our previous discussions, we have systematically engineered an architecture that processes, 85 distinct data fields?
85, yeah, across 6 layers of market reality. So that's fundamentals, narrative, regime, trend, entropy, and geometric order.
Right, and we take that vast ocean of data and we condense it into a single, actionable composite score.
And that brings us to the central tension we really have to resolve today. What exactly is that composite score? I mean, we've spent months building this architecture, and we look at the final output from 2 very different perspectives.
We do. My position is absolute here. The composite score we've engineered functions as an autonomous quantitative oracle.
An oracle? That's a strong word.
It is, but it fits. It represents an evidence-based truth that meticulously strips away human behavioral bias. The score is the altimeter in our fighter jet. When the system processes 85 fields and returns a definitive buy signal, you execute to buy.
You just follow it blindly?
When it issues an avoid signal, you avoid the asset. Yes. The score is not merely a suggestion or a starting point. It is the ultimate destination of our analytical process. Human discretion, the urge to second-guess the altimeter because you feel a phantom shift in gravity, is precisely what this system was built to eliminate.
I come at it from a completely different way. The composite score is undeniably powerful, I'll give you that. But it remains merely a static snapshot of the present moment.
A snapshot? It's 85 dynamic fields.
True asymmetrical power of this framework lies entirely in its context. Specifically in measuring entropy and transition states. That is your horizon indicator.
So you think the context overrides the score?
I think a high composite score is functionally meaningless if the broader market is suddenly incapable of processing fundamental data. The human discipline of interpreting exactly when to trust the dashboard is the actual source of alpha. The score is the output, sure, but the human overlay dictates the application.
Well, to determine whether the machine or the human craftsman reigns supreme, we are going to examine the logical sequence of our architecture in practice.
Let's do it.
We will first open the watching list dashboard to examine the geometric order and data structure. From there, we will test the system against 3 specific real-world archetypes. Stock A, representing pure expansion.
Right.
Stock B, representing structural decline. And Stock C, representing the volatility of recovery. Following that micro-level analysis, we'll zoom out to evaluate portfolio and macro health, confronting the illusion of diversification.
And we're capping it off with the academic validation, right?
Yes. Finally, we will validate the entire framework against 5 independent peer-reviewed studies published in the Financial Analyst Journal in 2026.
Let us begin by opening the watching list dashboard then. This dashboard is where abstract market geometry translates into a tangible user interface.
It's the command center.
Exactly. When a practitioner looks at this screen, they are presented with a sortable table. The composite scores are color-coded, ranging from deep green for high conviction to bright red for absolute hazard.
But it goes deeper than just a single number, right?
Oh, absolutely. Alongside these scores, we utilize what we call wall pills. These are visual indicators that display the exact count of green, yellow, and red fundamental gravity walls. We implement a market clock system, mapping cycle positions strictly from 6 o'clock, which is the absolute bottom,
to 12.00, the euphoric peak.
Right. We assign geometric order labels, categorizing price action explicitly as anchor, velocity, or acceleration, And finally, we track the TrendWise signals clearly delineated as open or closed.
The philosophy governing the first discipline of this dashboard is uncompromising. You sort the entire universe of equities by their composite score, and then you systematically scan for contradictions.
Contradictions between the layers.
Yes, this architecture enforces total, unapologetic objectivity. Think about what that actually means in practice. If you observe a high composite score paired with a red geometric order flag, the dashboard is mechanically signaling an impending override.
It's a warning light.
It forces the practitioner to recognize that the structural integrity of the trend is failing, entirely preventing emotional attachment to a deteriorating asset. The rules are visually encoded so they cannot be ignored. You cannot argue with a red geometric flag.
I have to push back on that. You're suggesting that the score and its visual representation provide complete protection.
They do, if you follow them.
But the dashboard's absolute brilliance is not in confirming what works. It is in revealing precisely when the market mechanism itself is broken. Consider the inverse scenario.
Okay, let's hear it.
You sort the dashboard and find a low composite score, but it is coupled with severe entropy compression. Let us pause and define what entropy compression actually means in this context.
It's a concept from information theory.
Right. In information theory, Shannon entropy measures how predictably data is moving. When we say entropy is compressed, imagine a crowded room where hundreds of people are having independent conversations about different companies, different earnings, different innovations.
A healthy, diversified market.
Exactly. Now, suddenly, the doors lock, the lights flicker, and every single person in the room stops their individual conversation and starts chanting the exact same word. Perhaps inflation or interest rates.
The market becomes driven by a singular macroeconomic variable.
Exactly. The market has stopped looking at individual company fundamentals entirely. Information processing is severely constrained. So, if you have a low composite score during a state of compressed entropy, that does not merely indicate a structurally bad stock.
You're saying the score is artificially depressed?
I am saying it indicates that the market is temporarily fundamentally incapable of processing that company's financial realities. If you solely follow the autonomous score, you miss the profound underlying mechanics of why the asset is mispriced in the first place. You are reading the altimeter while ignoring the fact that the plane is upside down.
I see why you think that. But your analogy assumes the altimeter is flawed if the plane is inverted. The altimeter is still providing the absolute measurement of distance from the ground.
But the distance to the ground is closing rapidly.
The composite score is providing the absolute measurement of mathematical viability. If the room is chanting one word, the system adjusts the regime layer to account for that macroeconomic dominance. To test the resilience of this instrument panel against your skepticism, we must move from theoretical architecture to practical application.
Okay, let's look at the actual data.
We begin with the absolute highest conviction signal currently registering on the board, stock A representing the expansion archetype.
The perfect stock.
Exactly. Stock A presents a composite score of 87, categorized mechanically as a strong buy. Based on this score, the system automatically allocates a position weight of 6 to 8%.
Let's unpack the specific layers driving that 87.
The market clock is positioned explicitly at 9 o'clock, indicating a Phase 2 mid-recovery. The corporate clock registers at Stage 3 or 4, meaning the business model is proven and scaling.
And the fundamental gravity walls?
Crucially, all 4 fundamental gravity walls are green. This is not hypothetical. Revenue is not only growing above 10%, it is actively accelerating quarter over quarter. Operating margins are above 15% and expanding.
And the return metrics?
The return on invested capital decisively exceeds the weighted average cost of capital, meaning every dollar this company deploys is generating actual compounding value.
The secondary layers are equally flawless on stock A. The geometric order explicitly registers as a 1, denoting velocity. The asset is maintaining a steady, linear uptrend without erratic volatility.
It's practically drawing a straight line up and to the right. And the TrendWise indicator is open, currently
Carrying a positive unrealized return. We look at the hidden Markov model regime classification. Let us explain what a hidden Markov model is doing here.
Please do, for those who might not be deep into the math.
It is an algorithm designed to predict an unseen regime based on visible clues. It's much like guessing the season outside based on whether people are wearing heavy coats or sunglasses. The hidden Markov model registers a bull regime with a statistical persistence exceeding 95%.
So it's incredibly stable.
Yes. The Shannon entropy is situated in a normal regime, indicating healthy, diversified information processing. The economic moat is classified as both wide and expanding. The long bull blueprint confirms a compounding match, formally categorizing the asset as a compounder.
I plant my flag firmly on stock A. This is what pure, unadulterated conviction looks like, when all 7 independent buy conditions align with mathematical perfection.
It's undeniably impressive on paper.
The system has processed the 85 fields, the fundamentals are pristine, the narrative is accelerating, the regime is fiercely bullish, and the geometric trend is indisputable. The system has done the rigorous work.
So you just buy and hold?
The only logical, mathematically sound action is maximum allowable allocation. Any hesitation here is a failure of discipline.
I look at that same perfect score of 87, and I see a massive trap.
A trap? It's mathematically perfect.
You are entirely ignoring the inherent danger of a perfect score, and it lies in the concept of complacency. You state the market clock is at 9. By definition, 9 borders on late-stage expansion.
It's mid-recovery heading into expansion.
The euphoria is already priced in. If the clock is at 9 o'clock, we must interrogate whether phase 3 is silently creeping in. I pose this critical question to you. When a compounder reaches perfect consensus, does the absence of doubt become the greatest risk to the capital?
That implies the system is incapable of pricing in consensus, which it explicitly does through the regime and entropy layers. If the consensus becomes toxic, the geometric order will fracture and the score will degrade.
It prices it in, but human capital allocators often misinterpret the peak. We must actively monitor stock A for the capital asset pricing model phase 3 fingerprint.
The CAPM fingerprint. Explain what that looks like under the surface for this specific archetype.
It manifests when an asset-specific alpha begins decelerating while its R-squared value simultaneously rises.
Okay, let's break that down.
R-squared measures how much of a stock's movement is explained by the broader market index. When a company is a true independent compounder early in its life cycle, its R-squared is relatively low because it moves on its own merit.
It's generating its own alpha.
Exactly. But when R-squared rises steadily toward 1.0, the stock is no longer an independent idiosyncratic compounder. It has simply become a leveraged proxy for the broader market index. Everyone owns it. It is in every ETF.
Right. Passive flows take over.
The score of 87 tells you it is perfect today. The rising R-squared tells you that its perfection is becoming highly fragile.
Wait, hold on. You're telling me we engineered a massive 85 field system requiring vast computational power specifically to hunt for the perfect stock?
Yes.
And the exact second we find one scoring an 87, I am supposed to panic because it is too perfect? Why build the system at all if you are going to flinch the moment it works?
It's not flinching, it's contextualizing.
Doubting the 87 because of an abstract fear of consensus is a direct reversion to the emotional trading we are trying to eradicate. The system is explicitly designed to hold the asset until the composite score organically degrades to a sell threshold. You are actively attempting to front-run the math.
I am not front-running the math. I am reading the derivatives of the math. A static score is Newtonian physics. It tells you an object's mass and velocity right now, but markets operate on thermodynamics. We need to know how the heat, the entropy, is transferring through the entire system.
And you think stock A is overheating?
Stock A is hot, but the energy is dissipating into the index.
Let us examine what happens when the thermodynamics completely freeze then. We move from the perfection of stock A to the absolute zero of stock B, the decline archetype.
The other end of the spectrum?
Stock B carries a composite score of 28, designated strictly as a void. The market clock is advanced to the 3.00 to 4.00 range, which explicitly maps to a phase 4 late collapse.
A painful phase for any investor caught in it.
The narrative surrounding the company is definitively dead. The fundamental gravity walls are fractured. We see 2 green, 1 yellow, and 1 red. Revenue is structurally decelerating.
And the price geometry?
The geometric order is 0, categorized as an anchor, meaning price action is flatlining, trapped below a declining 200-day moving average.
The secondary indicators are equally hostile on stock B. TrendWise is definitively closed, meaning our defensive gating mechanism has sealed the asset off. There is no buy crossover present.
The gates are locked.
The hitting Markov model registers a bear regime with 93% persistence. The Shannon entropy is severely compressed, resting at the 15th percentile.
Back to your crowded room analogy.
Exactly. Everyone in the market is chanting the exact same bearish thesis about the specific stock. The economic moat remains wide, but it has downgraded from expanding to stable.
Stock B is a mathematically verified dead money trap. Now, if a traditional discretionary value investor looks at stock B, they might see a bargain.
They always do. They see the wide moat.
Right, they see a wide moat, they see a stock down 60% from its highs, and they convince themselves the market is overreacting. But the framework strips away that hero complex.
It does. It forces you to look at the trend.
The hostile macro environment and the severely compressed entropy mathematically dictate that this stock is functionally a falling knife. The system generates a score of 28 avoid, and that quantitative output demands absolute unwavering patience. Capital preservation is paramount. You do not touch this asset.
The score of 28 demands patience, yes, but it obscures the nuance of what is actually happening underneath the hood. We call it the theory of concentric circles.
Concentric circles. Explain that in the context of a 28 avoid.
But if you only look at the score, you see a 28. But consider the concentric circles expanding quietly beneath the surface of the price action. Even as the dominant narrative contracts and the entropy compresses, immense fundamental infrastructure was deposited during the previous business cycle.
So the underlying business is still building.
Notice that on the long-term chart, every single crash floor in stock B held firmly above the prior cycle ceiling. Real capital expenditure was deployed into physical assets. Real sticky market share was retained.
But the market isn't pricing that in.
The fundamental circle is actively expanding even as the narrative circle collapses and drives the price down.
A fundamentally expanding circle is completely irrelevant to a portfolio manager if the price geometry is an anchor and the regime is relentlessly bearish.
It's not irrelevant if you're tracking the transition.
You cannot pay out returns to investors using a theoretical fundamental circle. The composite score correctly penalizes the asset for dead money duration.
But stock B perfectly exposes the explicit limitations of relying solely on a static composite score. The 28 avoid tells you exactly what to do now. It prevents immediate capital destruction.
Which is its job.
But the concentric circles, combined with our trigger alerts, tell you when the dynamic will ultimately shift. We are not just blindly waiting. We are waiting for specific mechanical fractures.
Fractures in the bear thesis.
We are waiting for Shannon entropy to diversify outward from the 15th percentile. We are waiting for TrendWise to trigger an open crossover. We are waiting for the hidden Markov model bear persistence to break decisively below 85%. If you only look at the static score of 28, do we miss the tectonic plates shifting silently beneath the surface?
You are introducing an element of anticipation that the score is designed to render entirely unnecessary. When the tectonic plates shift, when the entropy diversifies, the score will mathematically update to reflect the new reality.
But you're late.
You do not need to anticipate the shift. You just need to react to the updated score.
But by the time the composite score registers the shift from a 28 to a 70, the highest velocity repricing event has already occurred. The explosive alpha is generated in the transition state, not the steady state.
That concept of waiting for the silent structural shift brings us directly to our third archetype, stock C, the recovery archetype.
This is where it gets highly volatile.
This is an asset where the tectonic plates have just violently cracked open. Stock C presents a composite score of 72, categorized as a buy.
So it's officially actionable.
Yes. The market clock has just shifted rapidly from the despair of 5.0 to the renewed hope of 7.0, signaling an early phase 2. A definitive fundamental catalyst has fired, perhaps an unexpected earnings beat or a strategic pivot.
And the walls?
3 fundamental gravity walls are now green, And the fourth is yellow but mathematically improving. Revenue has officially reaccelerated in the most recent quarter.
The geometry is equally critical here. The geometric order is a 1, returning to velocity. Price has broken decisively above the 200-day moving average on demonstrably rising volume.
The trend is reversing.
TrendWise has just crossed to open within the last 14 days. The hidden Markov model is in an active, volatile transition state. Bear persistence has dropped sharply from 93% to 82%.
I framed this section as the mathematical climax of our entire framework. Consider the mechanical beauty of this transition.
It is structurally fascinating.
The catalyst fired, the quantitative rules were explicitly met across multiple layers without any human bias, and the system autonomously upgraded the asset from an uninvestable state to a 72. All 7 required conditions are now met.
The gates are open.
The TrendWise Open confirms the upward trend. The framework executed its mandate perfectly. It caught the turn.
You call it mechanical beauty. I call it a profound psychological shift in the Markov fabric itself. The most vital piece of data in Stock C is not the price action.
Then what is it?
It is that Shannon entropy has officially shifted from compressed to normal. Multiple information channels are suddenly active again. The room has stopped chanting the single macro fear, and participants are having individual conversations about Stock C's revenue acceleration.
The narrative is diversifying.
The stock went from being entirely ignored to being scrutinized and valued. The market has literally resumed processing the company's fundamentals. This exact transition from compressed, ignored, and cheap to diversified, noticed, and repricing is the precise event the entire 6-layer framework was engineered to capture.
To manage this live transition, we must enforce strict tactical discipline. A score of 72 at $7.00 is not the same as a score of 87 at $9.
The risk profiles are entirely different.
The framework dictates that if the TrendWise signal reverts to closed, the practitioner must immediately cut the position in half. There is no room for thesis drift. You do not hold on and hope the recovery resumes.
You trust the gate.
Conversely, if the hidden Markov model completes its transition and fully confirms a bull regime, the practitioner scales the position to maximum full conviction.
I agree entirely with the tactical scaling. The transition state is highly unstable by definition. The market is deciding whether the recovery is real or a dead cat bounce, requiring dynamic risk management.
But acknowledging that instability requires acknowledging a distinct operational reality for the human utilizing the framework. Managing Stock C requires a completely different psychological constitution than managing Stock A.
Oh, 100%.
Stock A, with its perfect 87 score, is akin to riding a luxury cruise ship. The trajectory is set, the momentum is massive, the waters are calm, and your primary job is simply to stay on board and let the math work.
Right. Don't jump off the boat.
But Stock C, catching the exact transition from 5.0 to 7.0, is akin to catching a falling trapeze. The timing must be flawless, the volatility is violent, and the risk of catastrophic failure is immediate.
It's a high-wire act.
Does utilizing this framework essentially require the practitioner to change their own internal geometry to trade both archetypes effectively?
It absolutely does. And this is why the autonomous oracle argument falls short. The framework provides the data, but the practitioner must possess the cognitive flexibility to operate as a momentum investor for Stock A, calmly riding the wave, and as an aggressive event-driven value investor for Stock C, catching the trapeze.
The system can't do that for them.
The system demands internal regime switching from the human executing it. An autonomous system cannot manage the psychological whiplash. It requires a craftsman who understands the context of the environment.
Let us expand our scope from the individual archetypes, from the micro-level physics of single stocks to the aggregate view. We transition to the entropy page and the macro page to diagnose overall portfolio health.
This is where we see if the portfolio is actually insulated.
This brings us to the critical concept of cross-stock entropy.
Cross-stock entropy is the ultimate non-negotiable safety valve in modern portfolio theory. It measures whether the equities within a watch list or a portfolio are behaving as independent businesses, or if they are moving as a single homogenized macro trade.
So correlation masking as diversification.
Precisely. When portfolio-level entropy drops severely, your diversification is exposed as a complete mathematical illusion. You might hold 10 completely different companies, a tech firm, a healthcare provider, a consumer staple.
Sounds diversified on the surface.
But if they are moving in perfect lockstep due to compressed cross-stock entropy, you are functionally holding one single stock wearing 10 different names.
I recognize the risk of portfolio correlation. It is a genuine threat when macro variables dominate. But the macro page provides the exact context required to navigate that correlation safely.
How so?
We deploy what we call the hedge versus arbitrage framework. By analyzing cross-asset signals, for instance, if the macro layer dictates that equities are a strong buy while gold is a trim, we establish a dominant, verifiable macroeconomic tailwind.
You're using the macro signals to validate the equity correlation.
If the macro environment is universally supportive of risk assets, the highly correlated equity risk within the portfolio is structurally justified. The framework actively endorses leaning into the correlation when the macro regime explicitly confirms it.
But I must ask the fundamental rhetorical question. If cross-stock entropy is compressed to the downside, if the entire market is gripped by a singular liquidity crisis or rate shock, are we genuinely managing 10 different companies with idiosyncratic value propositions?
Or are we just caught in the macro tide?
Are we just trading one macro regime wearing 10 different masks? Because if it is the latter, stock selection is an illusion. The individual composite scores of the equities in your portfolio are functionally meaningless until entropy diversifies again. You could own 10 companies with scores of 87, and they will all draw down simultaneously.
The individual scores maintain their relevance even during a macro drawdown because they dictate the velocity of the recovery once the macro headwind dissipates. The companies with an 87 score will violently outperform the companies with a 28 score the moment the market resumes processing fundamentals.
That's a fair point on the recovery phase.
However, we do not have to rely solely on theoretical debate to prove the efficacy of these mechanisms. We move now to the ultimate validation of our methodology. We built this entire 6-layer architecture from absolute first principles.
And the academic community caught up.
Now, we present 5 independent, peer-reviewed studies published in the Financial Analyst Journal in 2026 that categorically validate those exact principles. Let us unpack each one to demonstrate why this framework is empirical law.
Let's go through the 5 pillars.
First, Chen, Huang, and Jiang conducted an exhaustive study demonstrating that narrative transitions are the primary driver of the value premium.
This perfectly aligns with our stock C-Trapeze scenario.
They proved that it is not merely about a stock being statistically cheap. It is about the transition from an ignored narrative to an active narrative generating measurable alpha. This independently and conclusively validates our market clock methodology. It proves that the shift we observed in stock C from 5-0 to 7-0 is the actual engine of returns.
Second, we look at the monumental research by Baltussen, Martens, and von der Linden. They analyze an unprecedented 220 years of market data.
2 centuries of data. That's rigorous.
That covers world wars, depressions, and multiple industrial revolutions. Their conclusion was unequivocal. Trend following combined with downside absolute return metrics provides the single most effective downside protection across 2 centuries of financial history.
So it validates the gate.
This perfectly validates our implementation of the TrendWise defensive gating mechanism. It proves that systematically cutting exposure when the trend breaks, as we saw in stock B, is the ultimate survival mechanism. Third, Girard and Gend proved through their empirical models that stock-specific momentum generated strictly from fundamental earnings surprises does not exhibit mean reversion.
Explain why that non-reversion is so critical here.
Often, when a stock spikes on earnings, humans assume it has gone too far too fast and will revert to the mean. Girard and Gend proved mathematically that this specific type of momentum is structurally persistent. So you buy the breakout.
This validates our crossover conviction protocol. When stock C experiences an earnings catalyst and the TrendWise crosses to open, Girard and Geo prove that the resulting momentum is not a temporary anomaly to be faded. It is a structural repricing to be bought.
Fourth, Calamaris, Melik, and Memaisky utilized advanced natural language processing to map topic entropy across vast datasets.
The NLP entropy layer.
Right. They effectively trained algorithms to read millions of earnings transcripts and news articles to measure how many different topics were driving a stock. They concluded the NLP topic entropy predicts future market volatility and regime shifts entirely independent of historical price action.
It predicts without needing the price data.
This is a monumental validation of our Shannon entropy layer. It confirms that measuring the breadth of information processing, listening to the crowded room to see if they are chanting one word or having varied conversations, provides a predictive edge that simply looking at a price chart cannot offer.
Finally, we arrive at Joe and Kim. I submit these 5 pillars as the ultimate trump card for the quantitative approach. The framework we have built is not an elegant hypothetical theory.
It's grounded in hard science.
It is an empirically proven, peer-reviewed law of financial physics. The academic community has independently verified every single layer of our architecture.
I focus heavily on the final study by Joe and Kim because it explicitly supports my position regarding the absolute necessity of human overlay.
Wait, you think Joe and Kim proves the machine needs the human?
Joe and Kim proved mathematically that unconstrained machine learning models consistently overfit the data and destroy capital out of sample. Their core finding was that highly complex predictive architectures require strict human-designed gating mechanisms because certain predictors actually carry negative importance during specific market regimes.
If left unchecked, the model eats itself.
If you let the machine run autonomously, it will eventually trade on spurious correlations. Our framework functions precisely because it is constrained by human-engineered logic.
We built the architecture.
We built the hierarchy. We defined the entropy gates. The studies validate the precision of the tools we have forged, but they do not, and they cannot, replace the human craftsman interpreting the market context.
We have arrived at the synthesis of our journey. The final discipline of this framework boils down to 3 absolute, irrefutable truths.
Let's lay them out.
First, you must determine exactly what the market is processing at this exact moment, which is measured flawlessly by the entropy layer. Second, you must determine whether the current trajectory is structurally stable or fragile, which is defined by the geometric order.
And the third?
Third, you must verify whether the fundamentals, the narrative, the regime, and the trend are in total alignment, which is quantified by the composite score.
The 6 layers working together.
We have integrated 6 discrete layers. We are monitoring 85 independent data fields across thousands of equities. It all distills into one singular number on the dashboard. But I acknowledge, based on our rigorous stress testing today, that the number is just the starting point of the discipline.
I completely agree. The ultimate discipline is possessing the cognitive fortitude to know exactly when to trust the mathematical output, and knowing when the entropy explicitly dictates that the market has temporarily stopped listening to reason altogether.
The craftsman and the tool.
The human must know when the altimeter is reliable and when the horizon is inverted. As this framework transitions out of the theoretical laboratory and into the brutal reality of daily practice, I leave you with this final thought.
Go ahead.
If our dashboard perfectly models the market today, what happens to the market's entropy when the market inevitably learns to model the dashboard?
This is the research desk officially signing off.